if you still are adamant and say, no, I will not take any kind of stock market risk, it's all gambling, that's what my parents have told me, I will stay away from that, then okay, that's fine. You can still go for that 7% safe return. But to afford that 120 rupees cup of tea in 2053, you need to invest not 15 rupees but 31 rupees. Now, do you have
which one is scarier? I guess that's the question.
Do you have that extra amount? Do you have 2x the amount? You are spending X and you say, I won't take risk. Then the cost of not taking any risk is 2x. And that's really scary. So the biggest risk is not taking risk, not taking capital market risk. If you say, I want fixed returns, then you will have to throw money at it. People don't have money because inflation is killing their spending power today.
Hello and welcome back to Let's Get Rich with Pattu. After an interesting week last week, which has led to a lot of questions and a lot of interesting feedback, I think we struck a nerve while talking about the non-salaried people of India who continue to earn but irregular income. But to any thoughts after that episode, any further insights you'd like to give to our large community, and how are you doing? I know we both have sore throats, or at least I do. I wouldn't say the same for you, but how are you doing?
I'm doing great. I hope you feel better soon. So the freelancer episode was received very well. We had a wonderful time on the show talking to the couple, and we received some comments about how insightful it was, and hopefully we would like to add more insights along the way.
I'd like to quickly name some of you who wrote in. At the rate Thiru TWTS, who's listened to all episodes and highly recommends it for everyone. We've also got feedback from Prashant Giridharan and Dinesh Kumar. Thank you so much for writing in. And of course, Shubham's episode continues to be, a flag bearer for this show. Shubham, thank you for that. A lot of people have really felt something important about, why should we rush towards financial independence. But on that note, let's introduce this week's topic. And but you can help me here. The entire premise of this is, on a weekly basis, we face a dilemma on Let's Get Rich with Pattu. When Pattu and our team talks and we try to figure out what we should talk about on each episode, the dilemma we face is, should we go deep into some topic, which is what Pattu has been doing on his YouTube channel often, or should we think of the people who are starting out their investing journey? Which is the larger audience, right? The data isn't enough yet, so I think we're in a situation where we'll try and mix it up. Today's episode is all about, if the basics are in place, and to revise them, if you have your emergency fund in place, if you have, for the freelancers, the freelancer fund in place, you've worked on it for a few months very diligently and it's in place, if you have medical insurance in place, and perhaps if you have term life insurance in place, what then? What should be my first investment? And Pattu, it's a very interesting topic because you come to a stage when you've kind of laid the foundation. You have now some money to invest and think about your future. What are the next steps? What should be the thought process? And why did you think about suggesting this topic?
The first thing that came to mind when it comes to money management for beginners is, they're in a hurry to invest. They're in a hurry to buy that first product. So that's why we first talked about emergency fund, insurance of different kinds, and so on. So while doing all this, one should not think about investing. One should build the foundations, and now one is ready to actually start investing. Even now, I would say, give yourself 2 to 3 weeks thinking about what you're going to do, and then you can buy your first product. The biggest problem that money managers face is that they buy without thinking about why they're buying it. What is the actual end use? And after a couple of years, their portfolio is in such a big clutter, it's very difficult to actually unravel it and align it to one's goals and so on. So it's okay to take it slow. A few weeks here and there is not going to make a big difference to the wealth that we create. So we can take this time to think about what our short-term needs are. Short-term needs means things like expenses that we're gonna make every year. For example, vehicle insurance, health insurance, life insurance premiums. If you have kids, then you have to pay the tuition for the school, etc. Those are things that you're going to pay every year, and the best way to handle that is via the good old recurring deposit. I think we have mentioned this sometime in the
In
previous
the first or
episode.
second episode, yeah.
Yeah. So the recurring deposits will take care of the annual expenses, the emergency fund, and then you have taken care of the annual expenses. The next step would be to think about the kind of money you need for, let's say, in 2 years' time, in 3 years' time. Maybe you want to go on a holiday. Maybe you want to buy the latest Mac Air or whatever model that's available then. Something like that, some kind of a short-term goal that you want to spend on in the next 2-3 years. So that would come under saving. So in saving, you're going to put your money in some kind of secure instrument where the money that you put in does not fluctuate, the value does not fluctuate, and you know beforehand the kind of return that you're going to get and the kind of maturity that you're going to get, the final maturity amount that you're going to get. The classic investment is, of course, the fixed deposit. So for these short-term investments, you can happily choose a fixed deposit and be done with it. So I would suggest everyone to make a list of these short-term goals. What is it that I want to be spending on in the next 2 years, 3 years, 4 years? And I would say that you can even stretch it to 7, 8 years. That's absolutely fine. So up to that time, you can happily use a mixture of recurring deposits for regular cash flow that you're getting. You can put it there, or if you are going to get a bulk amount from time to time, you can open fixed deposits, and you can manage your short-term needs via saving in those instruments. Then I would urge people to think about their long-term goals. And I have mentioned sometime before that everybody has one goal, whether they have thought about goals or not. It is financial independence or retirement with financial independence, however way you want to call it. And for most people who are listening in, that should easily be 2 decades or almost 3 decades away, right? And that's a long time, and a long time for you to invest in. So that would be a long-term goal. And for people with kids, maybe in the next 10 years, 7, 8 years or so, you may have to send them to college, and that's another goal to think about. So we will first focus only on the retirement goal or the financial independence goal. So that would be the long-term goal. So how am I going to invest for such a goal? So I have now used that word invest. I've now changed from
saving, yeah,
to investing. So what
so
is the
if you
difference?
continue to save like we did for an emergency fund or a short-term goal and use fixed deposits, if we continue to do that diligently with discipline, why is that not enough?
One word: inflation. So we will
All
talk
right.
about that in some detail, maybe right away. So let's say you go back in time to the year 1990.
Right.
In the year 1990, you could have had a cup of tea on a roadside tea stall in India for 50 paisa, half a rupee, happily. Even in a metro, you could have 50 paisa would have been enough for you to get a cup of tea somewhere. So let's say in 1990, you had 1 rupee with you. That's not a big ask. You could have had 1 rupee in 1990, 33 years ago. You take half of that money and you buy yourself a nice cup of tea.
Sure.
And for the remaining half, you want to put it in some instrument, whether it's a saving instrument, investing in whatever it is. We want to put it in some financial instrument where the money will grow. And after 33 years, you redeem that money. You don't touch it. You take that, you invest that 50 paisa in 1990, and for 33 years, you have left it untouched. In 2023, you go to that instrument, pull out the money, pay whatever the tax is necessary. You can't avoid taxes, and you're going to be left with some amount. Now, the question is, would that amount be enough for you to buy the same cup of tea, probably in the same shop, assuming it's still alive, on the roadside in 2023? So the question then to ask is, what is the amount needed today to buy a cup of tea? In a very ordinary shop, no frills, just on the roadside, you would need anywhere between 12 rupees to 15 rupees.
Absolutely. Basic.
Right? At least 12 to 15 rupees. So, which means that in 1990, you had put away that 50 paisa. So, that 50 paisa should have grown in 2023 to at least 12 rupees after deducting tax.
Right.
Which means the question to ask is, what is the rate of return, or what is the rate at which that money should grow, so that I can drink the same cup of tea I drank 33 years ago today? The
Right.
answer is about 11%
Per year.
approximately. It won't be a regular 11% increase, but it's an average increase of 11% over this 33-year period.
Is that
That's what we call as
11% inflation, or should that 50 paisa have grown at 11%, or both?
It is the same in the argument that you are making. So that what costed 50 paisa in 1990 costs 12 rupees to 15 rupees today, and that rate of inflation is about 11%. So if I had invested 50 paisa in 1990, and after paying tax in 2023, I want to enjoy the same cup of tea, nothing more, nothing less, then I would need my money to grow at 11% after tax.
Right. And you're saying
And that's a big
incomes and
ask.
salaries are not growing at that rate to make sure you buy that same cup of chai?
It depends. It depends on the area you work in. But typically, how much do our salaries increase? In the government, it increases, and for government jobs, it increases at a fixed 3% plus a little bit of inflation hikes. So it'll be about 5% a year.
Right.
In the corporate sector, it can fluctuate wildly. It depends on profitability. So it can be
Right.
a bumper year or nothing. So I mean, the point is now, as long as we are earning, you can manage to have that cup of tea.
Right.
But what if you stop earning? What after retirement?
Absolutely.
So let's.
So two questions,
look at
Pattu,
it.
before you proceed.
Yeah.
Sorry. One is 11 seems really high. I mean, if you follow news reports, or if you follow if you read the newspapers, it's usually around 6 or 7%. In the US, they're making a big deal of it being, maybe 4 or 5%. Right? So how have you arrived at this 11%? And that is scaring me a little bit.
Of course, this 11% is just for that one commodity. Is for that one cup of tea, and of course, it's a service. When you go outside and get it, you're not paying just for the cup of tea. You're going to pay the guy who is making the cup of tea. You're going to pay for the rent for that tea store and so on. So there are overheads that you're paying for. Of course, you can argue that if you make it at home, it's going to be a lot lesser. But the other thing is that that's just one commodity. But the inflation that gets quoted, in the media and etc., it's the average inflation across all our expenses for petrol, expenses for rice, for other groceries, clothing, etc. So I would say 10 years ago, if you had asked me, I would have said that the typical average inflation that one should assume while planning something is about 8%. But thankfully, since the growth of our economy, it has gone down by a notch by about 7%. So I would say approximately everything gets expensive by at least 7%.
And
but
clearly the fixed deposit rates.
A big catch.
Sure, go ahead.
Sorry, yeah, you're right. So the fixed deposit rates after tax are not going to match that. But there's something even more dangerous. We are talking about inflation in the current lifestyle. Nobody's lifestyle is going to be the same over decades, right? I mean, the guy who was drinking that cup of tea on the roadside in
probably from
1990,
Colombia,
yes. holding an Apple phone, maybe.
Yeah.
So
Doesn't want to be seen at that roadside stall.
yeah, so people's lifestyles are always increasing because the moment they get a hike in salary, they say that now I deserve to spend more.
Right.
It's not debatable at all. They just deserve to spend more. So, which means that the inflation in our lifestyle is probably much higher than that 7-8% that I just talked about, what is known as lifestyle creep. And if you put that all in, that can be a very scary number. I mean, that could inch closer to that 11% T example that we are just talked about. So that is inflation in current lifestyle plus the enhancement in our lifestyle. Because
Right.
if you have been driving a car for the last 10 years, and if somebody tells you you're not going to drive a car anymore, I mean, you would feel that you have failed in terms of money management, right? If somebody tells you you don't have enough money to afford a car anymore, you're going to stop it. That means you failed as a money manager, right? So it's a problem that we have to. So every time you add on something to your lifestyle, you have to think a little bit, at least a little bit, and ask, can I manage this uh, need, want, or luxury, whatever you want to call it, even after I retire? If you bring in that thinking, maybe you will hold ourselves back a little bit. I'm not saying don't spend at all, but at least have some kind of balance.
Right.
So let's say I have 30 rupees today and I use 15 rupees to drink a cup of tea. I have 15 rupees less. I mean, the same roadside cup of tea. I have 15 rupees left with me, excuse me. Now, I want to invest this 15 rupees for the next 20 years. And if I assume the same 11% inflation is going to exist, in 2053, the roadside tea would cost about 120 rupees, 121 rupees, something like that. Right? So, if I invest 15 rupees, assuming I get 11% after 20 years, after tax, that will end up with 15 rupees will end up growing to 120 or 121 rupees approximately. But if I choose a bank deposit or something that offers me 7-8%, where I say I want security, I don't want my 15 rupees to fluctuate at all. It has to be rock solid, and I need to know the maturity value that I'm getting. I'm not going to take any kind of risk on that. Then that at 7%, which let's assume that's post tax, it will only end up to 58 rupees in 20 years. So
Scary.
yeah, so you cannot afford that 120 rupees cup of tea on the road in 2053 if you don't invest right. If you still are adamant and say, no, I will not take any kind of stock market risk, it's all gambling, that's what my parents have told me, I will stay away from that, then okay, that's fine. You can still go for that 7% safe return. But to afford that 120 rupees cup of tea in 2053, you need to invest not 15 rupees but 31 rupees. Now, do you have
Which one is scarier? I
double
guess
that?
that's the question.
Do you have that extra amount? Do you have 2x the amount? You're spending X and you say, I won't take risk. Then the cost of not taking any risk is 2x. And that's really scary. So the biggest risk is not taking risk, not taking capital market risk. If you say I want fixed returns, then you will have to throw money at it. People don't have money because inflation is killing their spending power today.
But too, is
People
this the
don't have that
case
kind of money.
around the world, or is it a very Indian phenomenon? That's one part of my question. And the second part is, should not governments do something about it to ensure that the larger masses, you know what, I guess the question is coming from a place where, if I didn't hear this, and this should probably be taught in schools, the the masses at large are not aware about this, and therefore their future does not look great. So either the government does something for the citizenry of the country, um, or the education has to be rampant so that everybody knows this and invest for the future?
One thing I can tell you is that mm, inflation education has increased tremendously in the 10-12 years, in the past 10-12 years. I mean, it no longer takes too much convincing to get somebody start investing in equity stocks or mutual funds and so on. Maybe the COVID helped a lot. Maybe people sitting at home and reading stuff and so on, they did do a lot of trading and wasted money there in different directions. But it's a lot easier now to convince people to take some risk, because I have students asking me how should I start investing in the stock market. So which is a great thing. Now the best thing that the government can do is to make it clear to its citizens, you're on your own.
Exactly, right? That was the basis of my question. We are on our own.
I'm not going to subsidize anything for you, because running the government is basically like running a business. I mean, or running a home for that matter. If your income is 100 rupees, you can't have expenses greater than that. But the government is having expenses greater than its income month after month after month. And somehow, because of its policies and it's managing, it can't sustain. So the best thing that the government can do is to say, I'm not going to subsidize anything. I'm not going to give you any more freebies. You are on your own. All I can do is offer you an opportunity to educate yourself, to maybe to get yourself a job. That's about it. So we have to recognize that nobody will come and save us. There are so many people who would say, what is the government doing? It's not the government's job to help you. And inflation, if you look at it, it's a deep economic question. What you ask, is it happening in other countries? Now, the definition of inflation is quite simple. If you look at it, there is a rate of supply of goods, different goods, whether it's petrol or cloth or vehicles or anything that can be consumed or anything that can be purchased in a market. There's a rate of supply, and then there's a rate of demand, right? So if the rate of demand is a little bit higher than the rate of supply, not too much, just a little bit higher, then inflation would be a healthy low number. What that low number is very country specific. For example, for the US, they would say that the inflation of 2 to 3% is reasonably okay for them to have a healthy demand, and then they keep producing goods. In India, it's been pegged at about 4%. So that's a healthy inflation. Anytime this rate of demand and the rate of supply becomes mismatched, it can become mismatched on either direction. Then the inflation becomes too high or too low. Both of it is bad. And many people say that in India, our population is the problem. There's a saying that every problem in India, in 2 steps, you can trace it to its big population.
But isn't that a great strength?
Yes, that's exactly what I'm trying to point out. That I was also drilled onto that kind of mindset, but I've come to realize that our population is our biggest strength. That is
because of demand will always, that part of the equation will always be fulfilled.
We have a great demand, and we have always have a huge base of people in the lower income groups trying to improve their income and trying to earn more and spend more. And that is the main reason why we are currently the 5th biggest economy in the world, and that's going to be the biggest reason why in about 10-15 years we are probably the 3rd biggest economy in the world, which means that there's a lot of room for our stock markets to grow, because when the companies are becoming more and more profitable, it's going to show in the stock market price movement, which means that the risk is actually a quite reasonable risk. Investing in equity to try and tackle inflation is a risk, but it's a reasonable risk. And if you say my retirement is 20 years away, 25 years away, then it's a extremely manageable risk. But if you say I want money in the next 2 years and I want to put it in the stock market, that's not a risk you can manage. That's pot luck. So that's irresponsible. That's the difference between saving and investing. You save for the short term because you can't handle the risk of market fluctuations. But over the long term, there is a very reasonable chance that our stock market will do well enough to beat inflation. There's a difference. Many people say that I expect 15%, I expect 17% from the stock market. The stock market's job is not to meet your expectations. The stock market's job is to give you a little bit more than inflation at
But
that
has
time.
it proved to do so, say, since
Yes.
1990 when you bought that chai for 50 paise?
Yes, it has. And I've checked it for US data from 1900. And except for a handful of occasions, it was almost always rewarded the investor at a return greater than inflation. That does not mean you will get the return you want. I mean, your expectation should also be reasonable. That's very important. That's where the education comes. So,
Right.
So that is the reason why you should, invest a good chunk of your money in the stock market. Not all of it, a good chunk of it. To begin with, I would say no more than 50%. So let's say the total amount of money that's in hand is 100 rupees. Put 50 rupees in a index fund, in a Nifty or Sensex index fund, and 50 rupees in a fixed income instrument. Most of you having EPF would already have that fixed income instrument. Freelancers who don't have some kind of EPF kind of thing, they can open a PPF account, a public provident fund account, and that would be your half of your fixed income. So that's a simple 2-instrument long-term portfolio. EPF or PPF for the fixed income 50%, and the other 50% as in the Nifty or Sensex index fund. That's it.
Quick question: is EPF also limited to 1.5 lakh per year? Because I know for a fact PPF is.
EPF is not, but about 2.5 lakhs it's taxable. I hope that's
Got it.
I get my numbers right. But it's still a good. I mean, even if it's taxed for those who are earning a lot, even if it's taxed, it's still a secure investment. You get about close to 8%, and it's quite fine.
All right. And a key word that you kept mentioning was risk, right? So PPF seems to be very low risk. As soon as you start entering this world of your first investment and you tap into the world of equities and the stock market and mutual funds and probably an index fund, there is risk. And that is the one word that puts a lot of people off, right? And then you said, if you think of it as a 2-year investment, that's potluck. If you think of it as a 25 to 30 to 40-year investment, then it's a very manageable risk.
Yeah. So
why? What is the biggest risk? Perhaps that could be a start for your answer.
The biggest risk is ignorance and not wanting to learn. So I think a better word is to describe instruments. I would say a better word is volatility. A volatility in the price or the investment amount. So if you take a PPF or a fixed deposit, there's zero volatility. You know for sure that it's going to increase at a set rate. Of course, fixed deposit and PPF rates can fluctuate over time, but those fluctuations are very mild. And
is there any history of fixed deposits or PPF ever failing? I mean, that would have caused a lot of unrest, and I might have heard of it. But has there ever been a history of that?
The big banks generally don't fail. A big bank like HDFC, ICICI, or SBI.
But small banks have failed. So you're saying those fixed deposits also fail their investors? Is there no guarantee that the government gives?
It's the greed. I don't want to talk too much about the guarantees because people then end up making wrong decisions. I would say, take a look at the FD rate of these big banks, SBI, ICICI, HDFC. If the FD rate of any other bank is significantly higher than these rates, then you are taking a risk. Because they will have to derive an income much higher than that FD rate. So for example, let's say somebody gives a rate of FD of 10%. They will have to remain profitable, to remain afloat. They will have to make a profit much higher than that 10% to even give you that 10% back, which means you're taking a risk with your money. All this deposit insurance, etc. I'm not a big believer in that. I would say you should never get to a situation where that is invoked. And don't take risk of those kinds in the fixed income. Stay away from all kinds of hidden risk in fixed income segments. And in the equity segments, the volatility, the price fluctuations, it's visible for you. Whereas the risks or the dangers in the fixed income are hidden. Everything will look good, and then one day, bam, it strikes you, and then you say your money is locked out, etc. You have to wait for the deposit insurance to kick in, and so on. So why bother? Why should I break my head, lose my sleep over that extra 1%? I would put my money in a safe bank and focus on known risks, visible risks, with manageable risks with equity for the long term.
Right. So I guess the very important point we're making, Pattu, is that look, there is also risk in a fixed instrument, right? Although it's much smaller than equity, every bit of financial instruments, all financial instruments have some associated risk. And it's about how you manage it. And I think the risk of losing out is even bigger than the risk of investing, right? Have I said that right?
Yeah, I mean the problem is time. I mean, you can't once you lose it, then you can't take that risks. For example, if somebody comes to me and says, I'm 40 years old, I have never invested in the stock market, all my money is in fixed income instruments, help me beat inflation in the remaining 10 years, 15 years, then the amount of risk that you can actually take is going to be very low, because you don't have too much time. That's where young earners have to be really careful. The clock is ticking for them. They have to start investing as early as possible, so that you have the time as a cushion to bear those risks. Over those 20 years, 30-year period, the stock market will definitely crash at least 2 to 3 times. You can handle that because you started early, and you have the time to let it recover.
Right. And last point, Pattu, about this 50-50 division between fixed income and the stock market. Why so, and how important a role does asset allocation play?
So that is asset allocation, as you rightly defined. So too much of something is bad. Too much of fixed income means that you will not be able to beat inflation. The purchasing power of your corpus is going to degrade over time because of inflation. Too much of equity would mean the volatility in the corpus value is going to be too much, and that's something that you cannot control. That would mean that as your date of retirement nears, it would seem like potluck. Today, people say, okay, I'm 25, I'm going to only retire, and 30 years later, I can take all the risk I want. That's fine. But if you have seen a couple of good years, great returns, then you become greedy and say, let it slide for a little more time. Let it slide for a little more time. And then a big crash comes in when you are 40 or so, and it takes years for the market to recover. Then you're in trouble. So all your corpus, you've wasted that corpus, right? So you need a balance, like everything in life, work-life balance. This also needs a kind of balance. There are different ways to allocate these. Some would argue that young earners should invest 70% and 30% in 70% in equity, 30% in fixed income, and so on. I would say just 50-50 is just perfect. It has got the right balance of volatility and safety. You can sleep in peace without worrying too much about it.
Interesting. So to revise quickly, Pattu, what you're saying is once you have your basics in place and you've worked hard at getting your emergency fund in place, freelancer fund for the freelancers, getting your medical insurance, getting probably your term insurance, your first ever investment today, you said, Pattu, could be a Nifty or a index fund, right?
Along with your EPF.
Along with your EPF in 50-50, right?
That would all, yeah.
So some questions we receive for the team are, one is, they listen to our podcast, Pattu and Sid say this, and when they discuss it at home, say a father figure or a mother figure will say, no, what are you listening to a podcast for? Don't trust YouTube, don't trust social channels. Listen to me, this is how I've done it. Invest in gold. Some young person who you highly trust will say, invest in crypto. Some other person may say, listen, you have to do it in this particular stock. Put all your money in this one stock. So there are various inputs and pieces of advice you get from all corners. People you genuinely trust and people who genuinely want the best for you. How does one work through this entire quagmire of advice?
I think conviction matters, and that is something that takes time to evolve. That takes time. You have to read a little bit for that to to develop some kind of conviction of your choices. I would say until then, don't act. Just listen to these pieces of advices. Even this one, even the present one, you don't need to, if you're not convinced about buying a Nifty or Sensex index fund or 50% in EPF, you don't need to follow it. But what I would suggest is, don't buy something else immediately. Take the time to read a lot of you have a lot of videos, a lot of material today. That's why I said, don't be in a hurry to implement things immediately, because then there's then it becomes a lot of too messy to unravel. So take a time. Maybe it takes, for some person, 1 week is enough to convince them. For somebody it may take 6 months, but that's fine. But be disciplined in reading and evolving a strategy for yourself and follow that. Don't take anybody's advice, including ours, at face value.
Very interesting. I think that makes it pretty clear. Do your own work, listen to your convictions, take the time to think. Take the time to think about your goals as well as what you feel feels right. Um, Next question, Pattu. What should explicitly, and you don't mind saying openly, should not be your first investment? Any such list you have?
I think it's a huge list. I would say crypto, ULIPs, LIC policies, endowment policies, any kind of insurance policies with say that give you some kind of return back, chit funds, gold, real estate. I think it's is there anything else maybe? But peer-to-peer lending. These kids are on about those peer-to-peer platforms and so on. None of that. You don't need any of that. I think the number one investment for a young earner today is skills and avenues to build their income, increase their income, and the simplest mix is EPF or PPF plus an equity index fund. That's the simplest mix to make you wealthy. I think I've mentioned this before. I'll say it again. You don't become wealthy because of returns. You become wealthy because you have money. You need money to make money. So focus
Amazing.
on the income. Yeah.
And on that note, the last kind of slightly philosophical question that we always try to end our episodes on is, recently I was reading a book by MJ DeMarco, but I don't know if you've heard about it. It's called The Millionaire Fast Lane, right? And there's an interesting concept in that book where he divides people into three buckets, right? I don't know if you're accustomed to what a fast lane is, what a slow lane is while driving on a highway. It's very obvious. But there's also a sidewalk, right? So he says the first bucket of people are sidewalkers. And if I'm to quickly read, sidewalkers are for people where a financial plan exists in mindset, usually a paycheck to paycheck existence, where escape is sought through welfare, lottery tickets, maybe casino gambling, and various other forms of get rich quick actions. Basically, people who think about getting rich but don't do anything about it. So clearly, listeners on this show are not that. Then there is the slow lane, which is a dogmatic financial plan based on the fatal presumption that 40 to 50 years of gainful employment, circumscribed by frugal living, tortuous saving, and regimented stock market investing, will somehow make you a millionaire. And I'm worried that line kind of attacks us and our philosophy on the show. And then, of course, there's the fast lane, where it's an enterprising financial plan based on leveraged entrepreneurship that creates extraordinary incomes and asset values in short periods of time, circumscribed by the sense entrepreneurial framework, which is something he talks about in his book. It sounds like a bit of marketing. I'll be very honest. Perhaps we should not take it at face value. But is there, in your thought process, do you ever think about whether this advice is perhaps too slow for the masses to achieve financial independence, or is it the safest way?
See,
And is there a faster way?
I think there are two different kinds of risks here. There are the risks that you take with your money, with your investment for your long-term goals, with a specific goal in mind, and there are risks that you take with your career. There are two different things. I mean, I would say I'm all for taking risks with a career, especially when you have the age to do it before you're married. Because after you're married, have kids and so on, you can't take as many risks because it can fall flat on you. So I'm all for that enterprising mindset where quit your job, follow your passion if you want, and that's all fine. But I would say that is an entirely different lane to speak the same language compared to the investing lane. I would say separate them out. And there are many people who are in their late 20s or early 30s who write to me asking, I'm passionate about this. I did my BE because my parents forced me to. I joined an IT company because I had to. Now I'm having my interests are different and I want to follow this up. I tell them, save up to 5 years, 5 years of your expenses. Have a corpus for 5x, x being your annual expenses. So for then you can quit your job and try something out, and at least you know if it's gonna work or if it's gonna fail. If it's gonna work on the or at least there's a semblance of it gonna work, then you can follow it. But you at least have a cushion that you have that 5x corpus. This is different from your emergency, etc., etc. This is a completely different.
Absolutely, yeah.
Yeah, you're going to live off that money for the 5 years while you're going to try your passion out. That is fine. That's a reasonable risk. But a guy with no cushion trying that at 30 or 35 is going to be dangerous. It's a huge difference, and that's very risky. So I would say separate the risk from your career and the risk in your investment. There are two different lanes, and of course you should
Yeah.
take risks in your career.
Very, very well said, Pattu. Thank you for that. And I'll just end by saying, when I start off on a journey, a road trip, I'm very happy to be in the slow lane for a while, right? Watching the world zoom by, you're getting accustomed to the road. At least you're on the journey towards something, and you're not on the sidewalk, walking along and watching the cars speed by. You're actually on that journey. You've started your journey. And then, you never know. You take a slight turn and you're in the fast lane. You can come back to the slow lane, etc., etc. But start the journey. Continue to listen to Let's Get Rich with Pattu. And this show is nothing without your questions and your contributions and your feedback. Please keep it coming in. Do you want our episodes to be more skewed towards basics of investing and starting out in your journey? Or would you like Pattu and me to now start diving into the dirty details about current changes and tax regulations and stock investing and the cool stuff that perhaps the YouTube audience of Pattu would like to hear more of? Please write into us on Pattu's YouTube channel, Facebook, our Instagram page at Offspin Media Friends. Thank you so much for being with us this week. And Pattu, any last words before we sign off, and we'll see you next week?
Just take the time to introspect, look at your needs, and develop conviction. And see you again next week. Bye-bye.
Take care. Bye.